Nobody likes paying taxes. I don't know anybody that enjoys paying taxes. I want to take a look today at an example story of a couple named John and Jan who are going to retire at age 66 and then start collecting Social Security at age 67. And not only do I want to look at their retirement situation, I also want to take a look at their tax situation. So let's take a look at this example. John and Jan, to begin with, they're like I said, they're age 66. You can see here, and their Social Security that they're going to have coming in, John will have 3,000 coming in, and Jan will have 1,500 coming in. They're going to retire at age 66. As I said, they're not going to be quite 67. So they're going to need to pull some money before Social Security starts paying out. So to begin with, they have an account at Schwab with a mutual fund that is a municipal bond fund that is both state and federal tax free. And that has 45,000 in it. Next, John has a standard IRA with 350,000 in it, and Jan has a standard IRA with 150,000 in it. John also has a Roth with 17,000 in it. Now their home is worth around $500,000 and they have 45,000 in their checking account. The rate that I'm going to project their assets to grow is 4.69, and that's because I have their IRA growing at their IRAs growing at 5 and the municipal bond fund only growing at 3. Now let's take a look at what their expenses are going to be. Their expenses are going to be 5,500 after tax, and that's going to be inflated at 2.5%. As I talked about in another video, not everything will inflate at 3%. Some things will, some things won't. In this case, we're using an inflation rate of 2.5. If we haven't met yet, my name is Craig Thompson. I'm an owner at Fourth River Financial Group. I'm an owner along with Lynn and Nathan. We're an investment management and a retirement planning firm. If you don't have a fiduciary advisor that you're currently working with, please feel free to reach out. Contact information is in the description box below. Now, let's take a look at their retirement. Begin with, at age 67, they're going to need around $5,600 a month, and they're going to need to pull around 1,000 a month from their assets to give them their monthly needed income. That monthly after tax needed income is around $5,600. And we can see they have around just under $550,000 in spendable assets. Now let's come down to age 80, and we can see here that they would need around 7,700 in net monthly expenses, and we can see that they would need to be pulling around 1,300 from their assets to be able to have that monthly income. But we can see that they have over 700,000 left. If we come down to age 90, we can see they would need to be pulling around 1,500 to get them just shy of 9,900 a month in monthly income. And we can see they have around 800,000 left in their retirement assets. So in this scenario, we can see, okay, their retirement is in good shape. But let's take a look at their tax situation. We come down here and look at their annual tax. We can see that from year 2024 all the way out here to year 2029, they're paying absolutely zero in federal income tax. So that's something we want to take advantage of. They have 32,300 in standard deduction. A standard deduction, if you got that big of a standard deduction bucket, you want to fill it up and take advantage of it. Now, as I'm going over tax things, please feel free to consult a CPA with any tax decisions that you need to make. Now, let's take a look at this year 2024. What they can do is convert $29,500 from a standard IRA over to a Roth. So they can do a Roth conversion during that year and still end up paying zero in federal tax. We come back here to the tax situation. We look at year 2024. We have their Roth conversion, and we come down here and we can see they're paying zero in federal tax. They're paying only 77 in state tax, which is very negligible. Now, let's think about this for a minute. You have money in a standard IRA that's being taxed, that's going to be taxed. You can move that from a standard IRA over to a Roth and not pay taxes, and you take that money from a taxable situation to a tax-free situation. Folks, that's a fantastic bonus to be able to do that. We all need to pay our share of taxes, but there's certainly no sense of paying more than we need to. Now, in year 2025, they can do a Roth conversion of 19,000. And if we come back here and we look at 2025, in this scenario, they're still paying zero in federal taxes. And they're only paying a few hundred in state tax. Now, do you have to do a Roth conversion? No. For instance, let's say you had a stock you needed to sell. Maybe you'd want to do that in one of those years. But by all means, if you've got a standard deduction and you need to use it, it just makes sense. Let's fill that bucket up and do some Roth conversions. Or, like I said, if you had a stock you needed to sell, take advantage of that and maybe sell that stock. But any time we have a scenario where we can take money and move it from a less favorable tax situation to a more favorable tax situation, certainly something we want to do. And as I said, any tax situation, feel free to consult your CPA. Thanks for watching. If you have a question, please leave it in the comments section below. If you enjoyed the video, please consider subscribing to the channel and check out our next video.